Hey guys, Kevin Bupp here. Before we jump into today's episode, I've got an important heads up for all accredited investors that are tuning in today. You probably know that my real estate investment firm is Sunrise Capital. And today my big news is that Sunrise's Fund 4 is closing in a few days, on September 30th to be exact. So if you're an accredited investor and want to get access to immediate cash flow, as well as growth and tax advantages offered by Fund 4, go to investwithsunrise.com. We're wrapping up Fund 4 with one heck of an acquisition. A 6-asset mobile home park portfolio in the booming Columbus, Ohio area. This deal is pushing our built-in equity across the fund to more than $25 million. Plus, this deal alone has huge tax benefits and is likely to add another $20 million in depreciation benefits to all Fund 4 investors. But you have to get in now to take advantage of those benefits. Fund 4 will close out with 15 performing mobile home parks and parking assets, delivering immediate cash flow, long-term growth, and significant tax advantages for this calendar year. So if you're an accredited investor and interested in seeing if it's a fit for you, go to investwithsunrise.com. Again, that's investwithsunrise.com. Now, let's get to the show. Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cashflow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And today we have a very special guest, Dusten Hendricksen. He's the founder and CEO of Mailbox Money Real Estate. Dusten turned his path from a roofing and development into a mission-driven company focused on affordable, wellness-inspired multifamily housing. And today we're going to talk about how Dusten sources deals, structures syndications, and really elevates tenant satisfaction through thoughtful design and gives back to his community. And so, Dusten, my friend, welcome to the show. It's a pleasure to have you here.
Hey, thanks, Kevin. I see a lot of your posts on LinkedIn, so it's nice to talk to you.
Well, you know what happens is once you click one, I follow you around forever.
Yep.
It's a beautiful thing. So no, appreciate you coming on the show, buddy, and looking forward to learning more about you and your organization. Maybe let's back it up a little bit. I'll give you that brief introduction. I know there's quite a bit more to the story, so let's back it up and talk about kind of how you found your way into the real estate world.
Well, I was roofing, and I decided while I was roofing, I felt myself very attracted to the architecture of the homes. And I would walk through the homes and critique all the designs and the floor plans. And then I started building homes, and I realized I did not like working for the homeowner, and I wanted to own the homes. So I started building bigger and bigger multifamily, because at the same time we were building homes for homeowners, we would also build a duplex for ourselves and keep it. And I like the rewards of that much better, because we would build a home for a homeowner, sell it, and that cash would almost immediately be gone. Where when we held the asset, we would always have something long term. And I really liked that. And the tenants were always more appreciative than the homeowners. So I got more satisfaction out of doing that.
Was most of the stuff you're building for homeowners, it was like 100% custom? Or
Yeah, for the most part, we did some starter home stuff, but we always had customizations in it.
Yeah, I
But
can imagine. I mean, I feel like that takes a special type of builder. I mean, my wife and I built a home about 6 years ago, and we actually used it turned into be just a shit show, but we used a builder that mostly had done spec projects, and he's done some semi-custom stuff, and just realized we made a mistake about a year into the process, that he wasn't well suited for it, right? I mean, like there's lots of personal involvement, going back to the drawing board, redoing things, change orders. I mean, it's like especially when it's like our forever home, right? But so I was just curious as to, I think it takes a certain personality type to really thrive in that environment and want to do the one-on-one custom stuff. It's just, there's a lot there. Sure, they could be incredibly profitable, but again, just probably a lot of brain damage. Yeah, help us with some context here, timeline. Back when you were basically moving from roofing over to building homes, like what are we talking about here? 10, 15, 20 years ago?
yeah, so 2003 is when I
Okay.
had a roofing company. Well, 2002 roofing company, 2003 I built my first duplex. 2011 is when I really started building homes for other customers. So from 2003 to 2011, I was building stuff and doing roofing. And then I kind of sold out, went all in on the custom homes. And then that's when I realized about 2015 to 18 is when I realized I didn't like building custom homes anymore and started building larger multifamily stuff.
Okay. And then what did the evolution look like from that point? So that's in the last decade now. So you started
Yeah.
building larger multifamily properties now, 10 years fast forward. I mean, what does that 10-year span look like for your business?
So 2018, I found the syndication model, went to a Jake and Gino conference, and that's when it changed for the scale wise. Cause I had built up to a 30 unit building and I didn't really understand how you built bigger than that because I ran out of my money and I ran out of people that were close to me's money. And so 2018 to now, we basically learned how to acquire properties, and the acquiring of properties has been very slow the last few years. And that's when I went all in about 2020 to 22. We really pivoted to all development for multifamily. So now we use that same model, 100 units plus is what we try to develop. And uh, we use the syndication model, LPGP structure.
Okay. What does business look like on the development side? Obviously, late 2022 rates really started on their climb, and we've been in this now, higher than anticipated rate environment for a couple of years now. I mean, what does business look like in the development world for the last couple of years?
So at the same time, construction costs started going up roughly 2020, and we knew we had to pivot into a different model. So we found this premium workforce housing model where it's a 3-story walk-up garden style. And the costs, it's much easier to keep the costs relatively low and flat on that model because you don't have a lot of change orders. And at the same time, then interest rates started skyrocketing, and this model just worked perfectly. So we pivoted away from all of our Class A that we were building and into this model, and at that 2022 timeline. So it really worked very nicely. And then for the past 3 years, we've grown that pipeline because it actually pencils, and it's one of the few
Really?
development models that pencils. Yeah.
So I guess assuming land would be the same cost, you're building this more affordable type of project versus of a Class A. What are we talking about difference? So what's the delta between the two price per foot?
Oh, a lot. So 200K per unit for Class A, and we can build these for 150 and sometimes a little bit lower. And the
Wow.
rents are maybe 10 to 20% different. So we get a huge savings, and rents are only a little bit lower, and our occupancy is actually higher as well because there's more tenant base in the cheaper rent.
Where are some of the areas where this cost savings really shines through?
So all surface parking, no underground parking, no garages,
Okay.
no corridors. So we have smaller boutique buildings, and we do multiple buildings. So we also save on all the engineering and the architecture because it's copy and paste. Easier civil design as well. No elevator, no amenities. So no dog park, no pool, no hot tub. And we put them in real nice locations where we just utilize the amenities that are around us. So then it reduces maintenance costs.
Hmm.
They're easier to lease because they're cheaper rents. And we focus on the interiors being super high end. So our interior looks just like a flat you'd have downtown, but our price is about half. Normally a flat's about $2,000 downtown. We provide a very similar apartment layout in the suburbs for about 1,000.
Interesting. Are you finding others are gravitating towards this type of model that might have been stalled over the last couple of years in the development world?
Not yet. We're seeing very minimal people shifting over to it. What we find is developers know how to build two different styles. They know how to build the A class with all the amenities, and they know how to build the tech or affordable housing, which is as cheap as you can build it. And we're looking for the market rate uh, apartment buyer that wants a little nicer than the affordable housing, but doesn't want to pay Class A prices.
Yeah. And let's be honest. I mean, maybe I'm wrong. I'm just making assumptions here, but like you talked about all the amenities that you guys forego, like, the dog park and the swimming pools and the gym and the fancy big ass clubhouse with a pool table in it that no one ever uses, right? I
Yep.
mean, again, I know that it's mostly used for marketing purposes and it just improves the overall aesthetics of a community. But I'd love to know the real data points on how many residents that live in these types of Class A buildings actually utilize the amenities. It's got to be in single digits, I would think. Maybe I'm wrong,
Yep.
but it's got
It's
to be pretty low.
it's very low, and then the percentage of time actually spent in them is very low. So when I go to our Class A properties, rarely ever do I see anyone in the gyms. in the community space. You'll see people in the office once in a while, and they're obviously using the underground parking. But we found that people, if you charge for the underground parking, they'll say, give me the spot outside. I'll save the $100 a month.
Yeah. Got it.
So it's a very low usage rate. And then also the amenities used to be more powerful when no one really had them. But now that everyone has them, people realize they're not using them. So if they can save $200 a month, they'll go save $200 a month.
Sure, sure. Yeah, I'm assuming even we speak to like the gyms in these apartment complexes. If the individual is a gym going type of person, they probably already had a membership anyway to LA Fitness or one of the other similar chains out there, right? And so
Yeah.
it's almost like a redundant expense for them. Um, no, it's all great. So I would love to know kind of your market selection process for this product that you're putting out there to the market. I mean, where are you guys building these? What markets are really on your radar today? And how do you make that determination?
So we started in Sioux Falls and eastern South Dakota, which is upper Midwest, and now we're expanding throughout the upper Midwest. We like high income, high education, low crime, suburban neighborhoods where all the infrastructure is new, the new schools are at, all the new shops. So bigger towns that we like: Madison, Wisconsin, Des Moines, Iowa, Rochester, Minnesota. It's not a bigger town, but it's got the Mayo Clinic, so they have very high demand.
Mm-hmm.
Lincoln, Nebraska, and a lot of these towns happen to have big schools too. Sioux Falls, South Dakota is a good one. Kansas City is a good one too. They've got really good comps, and most of these cities are starting the saturation starting to go away, so they're going to need more development as well.
Do you have any challenges with opposition? From building departments getting approval for this type of product. Uh, more as it relates to like they want the fans they want to look fancier, right? Like they want something that looks much more akin to that of okay, what is traditional, like this A-class stuff that's being built from the ground up. So I mean, how do you guys
Well,
overcome that?
the beauty with this is it's actually very attractive. So it doesn't look like workforce housing. So we put all of our money into the exterior to make a beautiful building, and then the location and the interiors. So those are the three things we look for. If we also don't call it affordable housing because then the city pushes back on it. So we call it attainable housing, premium workforce
Yeah.
housing. And so we built this marketing model. And it's when we go to the city, we know if they want it or if they don't want it. And if they don't want it, then we just move on because there's so many places that need it that we just want to work with the communities that want it. So if we have a lot of pushback, we just move on to the next location. It doesn't bother us at all.
Yeah.
But it is a very easy sell with the marketing materials we've created.
What type of debt are you guys? I mean, what type of lenders are you working with currently from this type of project? Have you guys ever done any of the HUD programs that exist out there?
Yeah, we are looking at I have done one HUD program on an acquisition, but we are going through the process right now of a HUD development.
Mm-hmm.
We use very little agency or HUD debt though, because we're locked in for so long. The local banks and lending institutions tend to have a mandate to provide this type of housing. So we get extremely good rates. The last loan we just locked in, 6.8%. It's a construction to permanent financing, 5 years, 30 months IO, very low origination fee of like a half a point. And the payment penalty is close to non-existent after 3 years. So, and it takes us about 3 years to stabilize anyways. So those are the kind of loans that we look for, and we're having really good luck getting them from the local lending institutions.
Yeah. And then what's the longer term strategy once you guys have leased it up, stabilized the property? Do you typically exit out, or are you looking to compile a larger portfolio of these workforce housing units?
We do whatever the macro level economy tells us to do. So we know that there's usually 1 year out of 5 that's really good to sell. So we try not to sell when we're in a downturn like the last 3 years. So we're building up all these assets. And then as the market gets better, people approach us. And even if we don't have stuff for sale, they'll say, hey, do you want to sell? So we know when a good time to sell is. We want to sell in between 4 and 10 years. We don't want to hold longer than 10 years that we can 1031 into another asset. But we want to refi whenever it is best for the asset. So if rates drop and we have higher leverage, we'll refi. Some of our loans are really good and there's no reason to refi. So we'll probably just try to look for a sale in five years. So it's so fluid. we don't really have an absolute concrete plan of what we're going to do, but we like to look at a refi from 3 years and on, and then we like to start looking at a sale from 4 years and on, as long as the market's
Yeah.
good.
I'm assuming if you'd make the decision at the end of year three, getting out of that construction to perm loan, you'd probably, agency would be probably best suited, or HUD.
Yeah.
Right? I know HUD programs are a lot more lengthy in time, and just they're fairly convoluted process to get through. And I've never personally done one. This is my understanding, but agency a lot more streamlined and probably would be the best suited at that stage of the game if you decide to hold for long term. Um, Talk to me about scaling across multiple markets. Actually running, ground up projects. I mean, it's not like you're just focusing on, Sioux Falls and then the various submarkets surrounding Sioux Falls, which still takes a understanding of those various submarkets and how they live and breathe, right? Like we're talking
Yeah.
about a number of markets and submarkets across the country, some that are 1,000 miles away from one another. So how do you gain a not just an understanding but a comfortability and an assurance that this project is going to work and work well in this particular marketplace?
Well, we first just build one complex before we really start building a pipeline out, and we can even phase that complex. But it's most important that you get a really good GC, because a GC can destroy your whole project. If a GC goes over 15% on the project, you're pretty much not going to make any money. So you have to get a GC that's really invested, that, in my opinion, you wants ownership of the property. And then we have an owner's rep. So we've built these things over and over and over. So we know exactly what it costs, what it takes. We know if we can look over their bids and know if they're missing something, and then how professional they are. So we want to get super comfortable with the GC. We want them to take ownership. And we also want to use some of their contacts to bring money in. So they're going to be a face of the project. So as long as they're taking a lot of ownership, it seems to go well. And some GCs, when they first work with us, they have to eat some cost because they just made some mistakes. But we can, with all of our experience, we can kind of show them like, hey, it doesn't look like you have enough in this bucket, or you have too much money over here. Can we get a lower cost over here?
Mm-hmm.
And then property management seems to be a little easier. You just got to make sure you get a really good property manager. But these things, there's a lot of value in them, so they kind of lease themselves. We found that it's what the market really wants, and there's not many people supplying this to the market. And we've created something that is easier to build. It's easier to lease. It's a phased approach. So we're building one building at a time. So the first building's ready in 9 months, next building 1 to 2 months after. So it does alleviate a lot of pressure on the GC, because you move your trades from one building to the next.
Mm-hmm.
And then we can also, with our updates, we know if they're going to be way behind and where they're at in the process of building. And then we try to help them out as they're moving.
Yeah.
And if it's not a good GC, then we have to start over and get a new project going.
I know you made a comment before we start recording that as far as your involvement in the organization, kind of where you spend most of your time, energy, and efforts is on the capital raising piece of it,
Yep.
working with LPs and bringing capital in for these various projects. I guess, what have you seen as far as the last couple of years, as far as just the amount of effort that has to go into raising capital? Is I think it's, generally speaking, it's become more difficult, but I guess,
Yeah.
what are you finding that's maybe working for you? And well, I guess backing up a little bit, even I would say that even like your typical retail investor, it's probably even a little bit more of a difficult sales pitch, pitching a development project, right? Because there's just a general feeling that there's more risk. It's a different risk profile, I guess I should say, not more risk, but a different risk profile of a ground up development than that of an existing project that's already
Mm-hmm.
producing cash day one. So talk to me a
Yeah.
little bit about like what you guys have been seeing in the marketplace, how the capital raising has been going, any strategic moves you've made to continue growing that side of the organization.
Yeah. Well, I'll first answer the point about the risk profile. In some ways, it's easier to raise for a new development because you're kind of selling a dream, you're selling a vision, and it's not there. And you're creating much more value than with an acquisition. So I can point to way more people that have acquired, or syndicators that have acquired assets and failed, than developers that have failed. because the development timeline is also much longer. You usually get about 5 years before you fail. A syndicator gets 2 to 3 years, and before they failing or before they failed. And so I have a lot of investments that I invested with other syndicators that went bad. I have no developments that have went bad. And so the value that you create is much more. So I can put a different spin on it in that case. And then I feel like the game has changed a little bit. And a lot of these older assets are going to be much harder to make money on long term to be sustainable. And what we're creating is something that's sustainable for the long term and designed for people that are living in this unit in today's age. So like I said, it's all communication. How do you communicate that message? In terms of how we're raising money, it's gotten way harder in the last few years. We used to just send out an email and the deal would fill up in a week, or they'd verbally committed in a week, and then you'd work at bringing in all your commitments. Now it's months and months and months of communication, just constant communication and constant, always talking about the current deal. And then we also have another deal coming up, but not releasing that deal too soon. Otherwise you get too many deals that you're raising for at the same time. But it's all communication, and we communicate constantly that we're raising money, always, just to let everyone know that we are doing it, because I feel like no matter how much you market, people still don't really know what you're doing, and you have to always put it out there. We've developed much better processes, funnels, and where I feel like the most impact has made is our nurturing system. You have to nurture people for a long, long time before they commit these days. So that's the biggest improvement we made, is that we have a lot more nurturing. And then I used to just be the guy that pretty much sold everything. And now we have one guy completely dedicated to it. So all he does is make phone calls and set up meetings and try to set up tours and try to set up appointments with me. And then we also have my executive assistant, or COO. She is heavily involved in communicating with these potential investors as well.
Yeah. When you guys do a tour, a property tour, I mean, you're just touring the ground, right? I mean, I'm assuming if you've got some LPs that want to come view, they want to more see the surrounding neighborhood in the marketplace, right? Because you can't show them a physical product at that point in time. Or do you guys take them to an existing product that you've built, and kind of show them like, here's what this is going to be in the next 18 months?
Yeah. So our goal is to get someone to come on a tour, personal one-on-one. We get 50% or more of the people that come on tour to invest, because we can explain to them all the differences of how we develop an apartment nowadays versus if you acquire an apartment, what that's going to look like. So, and then we also can have them talk to the property manager, and then the property manager says, yeah, these are easier to lease than a typical apartment because of the value proposition. And so we have a pipeline, and that's why we like a pipeline of deals, because the pipeline also impresses them. Because if we're able to build a pipeline of deals, then clearly there's a demand for these units. The bank has already underwrote them. There's multiple people underwriting this project. So it's just from this being on site and seeing the pipeline is an easy way to sell them. So we go to multiple deals, and then we show them the land. The land is just not very exciting to look at, so we usually show that to them last so they can get an idea of the neighborhood.
Yeah. No, that makes sense. And as far as the actual land itself, are you guys buying it pretty much fully entitled, shovel ready, or will you actually run the rabbit hole and go through that process with a raw piece of land?
No, we're not land developers, so we don't really get too involved. Once in a while, we'll get a little bit involved, but we would rather work with the land developer, give him an LOI so he can take that to the bank, or even a purchase agreement, so that his development looks better to the bank. He's already got someone willing to buy the multifamily land. So most land developers take a big chunk, and they can only a portion of it can be used for multifamily. Then they've got single family, commercial, everything that's in there. We come in right away and say, we'll buy the multifamily for this much, and then we can give them hard money down if they need. But we like to buy it entitled, ready to go, and that removes risk from the project as well. If it's not entitled, we'll usually buy it with our own personal money and and then go that route. But we don't really release the investment until it's ready to go.
Yeah. What do you see with the current business model? What do you see as maybe the biggest risk over the next 18 to 24 months? Again, none of us have a crystal ball, but surely you guys probably have some internal discussion as to the what ifs. And so, what do you
Yeah.
foresee as those biggest risks?
I always see the biggest risk as not enough demand for the units. So if people start becoming super price sensitive, which we've seen lately, lots of price sensitivity, it seems to get higher and higher all the time. How many people in one bedrooms are going to want to double up and come together and just get a two bedroom? Because a one bedroom's 1,200, but a two bedroom's 1,400. You can save a lot of money by getting a roommate and living in a two bedroom. And it used to be, since COVID happened, one bedrooms are more popular. Now the price sensitivity has gotten so large that we see that people are getting roommates. And so I think that is the biggest risk is the demand going to just continue, and are we going to be able to keep filling up our units, or are people going to run out of money and we're not going to be able to fill up our units? Although brand new units are the easiest to lease, so we usually take other people's tenants into our units. And so it's kind of a little bit of a catch-22, but that's always the thing is will the growth keep up, and will the income growth keep up so that the rental income growth continues?
Yeah. Yeah. No, valid points there and valid concerns. I'm assuming obviously you guys are doing your homework. You're leveraging multiple different resources to, to get, you'll use data to help drive those decisions. But no, it's definitely an interesting take on it. Folks moving from a one bedroom and, can start now. Let's get a roommate. Let's cut my costs down a little bit, get a roommate. I guess, given like that potential concern there, does that, does that drive any a difference in decision making of what your unit mix is on new prospective developments? Like what you would have built maybe 3 years ago, X number of one bedrooms, two bedrooms, three bedrooms. Has that differed now with maybe some of the price sensitivity that you're seeing in the marketplace?
A little bit. The problem is though, is those that fluctuates all the time. So
Yeah.
just 6 months ago, two bedrooms were not popular at all, and they were hard because so much supply had come on the market. People would not even take a two bedroom for the same price as a one bedroom because they knew that when the lease comes back, they're going to be either have to move back to a one bedroom, or their lease is going to go up 50% or 30%. So it fluctuates so quickly. What we look at is more, we'll come into an area, and if that area is heavy on three bedrooms or two bedrooms, we have a plan where we either have 14 units, which is more studios, one bedrooms, and we have a 12 unit, which is three bedrooms, and I think four two bedrooms per building. So it eliminates it eliminates the studios and two one bedrooms and converts them to three beds and two beds. So we do have different plans that we can bring into different areas, but we've seen a steady increase in need for studios over the past 10 years. And so I don't think that's going away. I think it's just cyclical. So it's just hard too. The data also is always behind. So
Yeah.
you don't really know that the data is until it's too late.
Yeah, no, interesting. I was just having a conversation earlier about data being incorrect, and the topic was even the number of units being supplied to a marketplace over the next couple of years, right? Not meaning from today moving forward, but in the last couple of years, like a lot of the data that was coming out, just it wasn't all that accurate, and a lot of decisions were made around that data, right? As far
Yeah.
as like, was there going to be an oversupply in the coming years that I need to kind of plan for? And so interesting to hear that. And I'm not going to mention names, but there were some well-respected sources out there, data sources that just were completely off mark on some of the reports that they provided the last couple of years. So it's kind of scary to think because a lot of us make decisions around that data. But
Yeah.
in any event, we love. I know we chatted a little bit about AI and just really the integration into your business, where you'd be able to find efficiencies by leveraging the power of AI. I know that it's an initiative that we have really taken seriously over the last 6 months with inside our organization, and I'd love to hear from your perspective of where you've been able to maybe buy back some time or buy back some efficiencies or gain some efficiencies in the organization by the use of whether it be Chat GPT or one of the many other AI tools that exist out there.
Yeah. So it seems like AI is being put into every software you buy nowadays. Um, But like I said, we're majority a communications company where we're talking to investors or we're talking to municipalities to see if we can bring our product to their area. And so I feel like ChatGPT is best used as a communication tool to improve your communication. You can rewrite your emails much more powerfully, super quick. And instead of writing out a whole email, you can just talk in a blurb quick and get your email. So our communication has sped up massively, and our minor projects that we have to do to put the ball in someone else's court is very easy. So what I used to call up my assistant and say, "Hey, put this on your to-do list. We need you to do this." And it would maybe on a Monday, she'd have it done by a Friday. Now, literally 15 minutes later, she'll have that to do moved on and put into someone's inbox because of chat. And it's the polish on the emails and the polish on the email chain or whatever we're doing, or the communication that we're doing, or the charts or the graphs or the OMs or the two pagers. It's just so easy to and also to change your communication. Like, oh, this change in the market, boom, quick, change it. Super easy. What used to take days, and you need copywriters and all that, we can just do in minutes.
Yeah. Yeah, no, it's a powerful thing, and I'm truly of the mind that those that are unwilling to adopt it and start integrating into their business, or we're going to look back 5 years, probably not 5 years, probably like 2 years or 3 years from now, and the landscape's going to be very different. And those that chose not to adopt the technology are going to not be necessarily left in the dust, but they won't be at the same level. It won't be a level playing field any longer. So, um, it's exciting and scary at the same time to think how powerful it is and just how quickly it's really taking the world by storm. I mean,
Yeah.
I was not having this conversation. I would consider myself not an early adopter, but not a late adopter. We're somewhere in like midterm right now, right? But like surely, someone that's been on this AI train for a couple of years would say like, man, we've been talking about ChatGPT for like 3 years now. Like you're a little behind the eight ball, and you need to get on the bus and get rolling fast. So, but I think we're there, and I think you and I are probably steps ahead of many others that are out there. But I would definitely say that it's one of those things where take 10, 15 minutes a day. Start watch a YouTube video to even just playing around with ChatGPT and leveraging it for writing emails, simple things, right? Admin type tasks. What are the things that you don't like doing inside your business? Is it writing an email? Is it creating a spreadsheet, creating an action plan? Well, start leveraging ChatGPT for those simple admin type tasks, and you'll be amazed at the results. So, um, Dusten, for those that want to learn more about you and your organization and keep up with your current projects, where's the best place to track you down?
Well, the best place to learn the most about me is on LinkedIn. Dusten
Okay.
Hendricksen, Dusten Hendrickson. And I give daily updates, personal stuff, business stuff, little tips, and otherwise mailboxmoneyre.com. So
Okay.
Mailbox Money RE is in realestate.com, and that's where it's easy to get a hold of us. We have all the contact info, and you can see all of our projects as well there.
Alrighty, good deal. Well, guys, I'll get that in the show notes. And Dusten, it's been a pleasure having you on the show, my friend. I appreciate you joining us.
Thanks a lot, Kevin. Appreciate it.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care now.